Look at this guy. He has messy hair, is sleeping on a beanbag, and is wearing shorts and a t-shirt while testifying before Congress. He was supposed to be the ethical face of the crypto world, the golden boy, the savior. Sam Bankman-Fried, or SBF, was just 30 years old when he became the CEO of FTX, an exchange valued at $32 billion. He told us that he wasn't making all that money to be rich, but rather to save the world, guided by a philosophy called effective altruism. He convinced us that he was a modern-day Robin Hood. We bought the story. Smart investors, celebrities, politicians, and millions of retail traders, including us, handed over our money. But while he preached charity, he was orchestrating the greatest financial theft of the modern age. In the blink of an eye, one single week in November 2022, that $32 billion empire collapsed into a smoking pile of debt, and $8 billion of customer money simply vanished. This isn't just the story of a market crash. It is the terrifying tale of what happens when a charismatic fraudster turns a global financial exchange into his own personal piggy bank. Let's delve into the most absurd financial tale of our lifetime. Our story begins with a philosophy. SBF was obsessed with effective altruism, or EA. At its heart, the idea is simple. You should use your life to achieve the greatest possible good. However, SBF distorted this concept. For him, the moral duty was to earn to give. He believed that he had to make unlimited money, even through morally questionable means, so that he could donate it later to save humanity. Consider that for a moment. The end justifies the means. This is a truly dangerous idea when dealing with billions of dollars. Armed with this philosophy, SBF jumped into the world of cryptocurrency. He launched a trading firm called Alameda Research. Think of Alameda as SBF's aggressive, secretive hedge fund. It made huge profits by exploiting tiny differences in crypto prices. He became obscenely wealthy extremely quickly. However, SBF needed a larger pool of capital and legitimacy. So in 2019, he launched FTX, a cryptocurrency exchange. This is where the illegal deception began. FTX was supposed to be our bank. We deposited our cash and cryptocurrency there, expecting it to be secure. FTX's only job was to hold our assets and facilitate trades. Simple. But SBF secretly and illegally linked our bank, FTX, to his personal venture, Alameda Research. This is the crux of the fraud, and it's shockingly simple. FTX did not hold customer funds. They simply transferred them directly to Alameda. Alameda used billions of dollars of customer money as its own limitless piggy bank. What did they spend it on? Risky, leveraged investments. They bought almost $300 million worth of luxury real estate in the Bahamas. They bought SBF a $30 million penthouse. They made enormous political donations to Washington, D.C. They were essentially gambling with our savings. To make this theft foolproof, they set up a secret backdoor in FTX S-code that gave Alameda an almost infinite line of credit, bypassing every security and withdrawal check. It was a digital hole in the wall, and SBF had the key. For years, the facade was flawless. SBF played the role of the ethical, humble, brilliant savior to perfection. He wore the uniform of the young, disheveled tech genius, t-shirts, shorts, and no socks. It was all part of a brilliant public relations strategy designed to disarm us. We looked at his shorts and thought, he's so focused on saving the world. He doesn't even care about clothes. Meanwhile, he was a master financial predator. The crash occurred in November 2022. It was triggered by something incredibly mundane, a journalistic report that exposed the truth about Alameda's balance sheet. The report revealed that most of Alameda's assets were made up of FTT, a crypto token created by FTX itself. Hold on. Consider this. Alameda's money was FTX's invented money, supposedly backed by our money. It was financial circular reasoning, a Ponzi scheme wrapped in crypto code. When this news broke, the market panicked. Investors realized their money was not safe. The moment of truth arrived, and there was a run on the bank. Customers rushed to withdraw their funds from FTX. However, FTX could not meet the demand. They were facing a liquidity crisis. Why? Because the money wasn't there. It had been quietly funneled to Alameda. In just 72 hours, the entire $32 billion company evaporated. SBF, the man who preached financial ethics, was forced to admit the truth. FTX had a shortfall of $8 billion. Our money was gone. SBF stepped down and the company filed for Chapter 11 bankruptcy. And this is where the story becomes truly absurd. The lawyer brought in to clean up the mess was John J. Ray III, who had previously overseen the liquidation of Enron. Even he was shocked. He famously said, "Never in my career have I seen such a complete failure of corporate controls." He reported that the company's accounting was a joke. Executives were approving multi-million-dollar transfers with emojis in a chat room. Money was used to buy homes for executives, but the properties were never listed in their names. The multi-billion-dollar operation was being run like a chaotic fraternity house. SBF was eventually extradited from the Bahamas, charged with multiple counts of fraud and conspiracy, and convicted. The man who claimed he wanted to save the world was revealed to be a thief who stole from his own customers. So what is the ultimate lesson of the FTX saga? It is a definitive warning about placing too much trust in charismatic individuals, particularly in unregulated spaces. It proves that no matter how complex or decentralized it is, technology cannot solve human greed. The lesson is chillingly simple. If a company's founder is too busy talking about saving the world to focus on basic accountability and the location of customer funds, you should run for the hills. SBF was a master of theft, and he almost got away with it.